Everything you need to know about inflation. When economists talk about inflation today, they refer to the general upsurge in the prices of goods and services. You probably have a discussion with your parents or even grandparents about the prices of goods and services, and they will mostly complain about the prices of commodities. As you probably had heard them saying, when we were your age, we would buy a bottle of Coca-Cola for 6 cents, or buy a cinema ticket for 30 cents, which is now more than $14. There is no doubt that the price of the currency has changed substantially over time. Hello guys, welcome back to my YouTube channel. In this video, I'm going to tell you everything that you need to know about inflation. What inflation actually is. Inflation refers to the increase in the levels of prices of commodities, or to make it simple for you, inflation means too much money chasing a few goods. You may have probably heard about the price of things that get high, such as medicines, groceries, the price of fuel, etc. Or, in other words, you could also say that inflation means the decrease in the purchasing power of a given currency over time. So inflation is basically opposite to the term deflation, which means a fall in the price of commodities. It is important for you to know about these ideas theoretically about the rise or fall in the prices of some categories of goods. What causes inflation? There are many factors that cause inflation. One factor is that many people in the country have confidence in the currency. After leaving the gold standard behind, the currency lost its real value, created on valuable metals. Now, in modern times, the currency has worth only because the citizens and the regulators say it does, and they believe it. However, in the worst cases, such as wars, that guarantee or assurance provided by the government goes into danger, so the money loses its intrinsic value. There is another factor that plays its role in inflation that is defined by the ratio of purchasing or producing in the economy, or the demand and supply. Let's suppose in 2021, each individual in a country bought the same amount of commodity, which was produced in the country. It means the ratio of demand and supply will be 1:1, which means there is no inflation or deflation in a country. Sounds logical, right? Now, what if less amount of goods are produced in the country and more people want to buy it? So the prices of the goods will definitely rise, which causes inflation. In the same way, if more goods are produced in the country and fewer people want to buy them, it will decrease the value of goods, which will cause deflation. Another factor is that government wants to boost the economy to create more jobs. As a result, they print more money by raising the number of notes in circulation, or they can do it by snowballing government debt or by permitting the banks to give bigger loans on the same value of security in all these cases. The amount of money in circulation increases. But there is an issue that this will lower the worth of notes because more notes are chasing certain goods. The Federal Reserve focuses on inflation patterns through the long-term price index, or the change in inflation rates through some kinds of products. There are basically two measures that are used: the Consumer Price Index, which looks at how much consumers are paying for a particular item, and the Producer Price Index, which looks at the amount which is listed by the producers. Without government rule, the disparity in the market supply and demand can be worsened by the deficiency of public confidence in money. When that happens, hyperinflation or hyperdeflation may transpire, and normal stuff can end up costing either a fraction or about 100 times more than what they normally do. If you go back to the history of World War I, Germany was having a tough time in the year 1923 while repaying the debts. As a result, the investors lost their confidence in the German currency and went into hyperinflation. What if inflation was zero? Would that be good? Is inflation necessary for a country? What if there was no or zero inflation? You may think that it would be the best thing if it happens, and you will be able to afford everything that you want. Further, you would be able to increase your savings, and the value of money would not depreciate either. Well, that is not normally the case. Now analyze deeply upon reasons that cause inflation, then you may understand that zero inflation is also not a good thing. When the economy of the country is not running at full capacity, it means that there are unused resources of labor. Inflation will help in increasing production. More currency means more spending, which means more aggregated demand, which will trigger extra production to fulfill those demands. Now, for instance, we fully remove the word inflation, or in another way, if there is zero inflation, then it means that your salary will not be increased and will remain constant. And since salaries never go down, therefore in general inflation stays in positive. There is another reason if there is deflation, which means that the prices of commodities are declining each year, and then people would not want to spend their money, they would want to save up. First of all, the value of money is upsurging, and if deflation continues to happen, then 5 years on, the goods that one wishes to buy would come for cheaper. As a result, we would want to buy such goods 5 years later instead of buying them today. This would cut down the overall public expenditure. Lesser spending would mean that the businesses would start incurring losses. As a result, people would lose their jobs. Yes, it can happen. So, in a certain situation, you could say inflation is necessary too. But if it gets too high, it would adversely affect the economy. Consequences of inflation. No matter how much importance inflation holds for the entire economy, if we come down to personal consequences and how it personally affects you, surely it will have a negative impact. The money that you are saving now will ultimately lose its value over time because of the increase in price of goods and services. Therefore, many people don't want to store their cash in the bank account. Instead, they invest such money in real estate, stocks, gold, or cryptocurrencies in the hope of increasing their purchasing power. The value of money keeps declining due to inflation, but the value of the investments keeps rising. There are other consequences of high and volatile inflation, such as it discouraging businesses and firms from investing because they see uncertainty in their profitability. Therefore, countries facing high and unstable inflation will face lower investment, and it will stop the pace of economic growth as well. So if there is a poor level of investment in businesses, it will create unemployment in the long run. Other ways to control inflation. There are some ways to control inflation. Some works while having some harmful effects as well. For instance, handling inflation through wage and price control can also create a recession and job losses. Government can also employ a contractionary monetary policy to fight inflation by decreasing the monetary supply within an economy through increased interest rates. This can assist in declining the spending because there is less money to go around. Those individuals who have money want to keep that money saved. High inflation means that there will be less credit available, which will also lessen the spending. It is important to reduce spending when there is a high inflation around. The government can also increase the reserve requirement in which banks are legally required to keep a certain amount of money on hand to cover the withdrawal. The more money banks will hold, the less amount of credit they will give to people. That's all for today's video, and thanks for watching. If you liked it, make sure to give it a thumbs up and share it with your friends. I'll see you in the next video. Take care and stay tuned.